just give you the introductory part of the fundamental analysis. It's more or less is going to open some keys for you to try and think about what the fundamental analysis and how it looks like. Hopefully, the Qatar Stock Exchange will go further to do this. I see this is a very interesting initiative. Thank you for Qatar Stock Exchange to arrange this. But as I said, fundamental analysis is quite huge, big topic, but we are going to go for the coming 45 to 50 minutes to try and just catch up and try and make this more understandable to the audience. So if I want to just talk about the fundamental analysis, what I exactly would like to talk about, I just want to move this, okay, is just to define what fundamental analysis and why do we have to care about fundamental analysis. And then we're going to go into a very basic introduction to these tools of fundamental analysis, like understanding the language of the fundamental analysts, which is the financial statements, and then try to understand these basic ratios and how to analyze them and look at them. And we're going to just briefly look at the valuation models without going into the details. And as I said, this needs more maybe advanced and more calculations. We're not going to focus mainly on calculations here. We're going to focus on more the understanding and the conceptual analysis behind the fundamental analysis. So what is fundamental analysis? I always say fundamental analysis is going to be one way of analyzing the publicly available information. Just show you these different skills, where to look for, and how to grasp this information that's usually available. Might be published by the company itself, about the economy, about the industries. So we collect all these informations for one basic target, which is making profitable and intelligent investment decisions. So that's my target behind going through the fundamental analysis. So the fundamental analysis is going to be very useful analysis. It just depends on the skills of the analyst himself, how he's going to read the information and bring these information together to have that a conclusion about the investments. I always receive that question, why do we have to bother about all these calculations with fundamental analysis? Actually, in fundamental analysis, we have to think about it like driving a car. Many would say, that I've received myself this question, would say, why do we have to go into the details of the engine where we can just press the button and drive our car? And maybe ladies are supporting this. Well, we don't have to bother about it. But the answer is very simple here. If you know the details about the car and the car engine, you can rescue yourself when you have any unprecedented fact or facts that you're not expecting. So you don't have to park on the side and wait for someone to rescue you. You can do that by yourself. It might be very simple to deal with. So in fundamental analysis, we try to make you able to understand better these different facts related to the company. So I would say the fundamental analysis would maybe support you and maybe make you not easily caught up with the general enthusiasm about the company and what it's actually doing and what is selling. So when you see your neighborhood, all of them are buying the products of that company and think this is a reputable company, not going this is not always going to be a good company to invest in. It might be the product of the company might be good, but if the company is not making enough money out of selling their products, that means it's not a good investment. So in fundamental analysis, we mainly focus on facts rather than and going deeper with the business reality rather than just go with feelings, opinions. We had to be more realistic when we make our judgment regarding the investments. If I go here about the fundamental analysis, it's not only fundamental analysis is needed when you are going to decide when to invest or how to invest or whether to invest or not, but actually it's going to go further with your, and when you make your investment decisions, this is going to be a very supportive analysis that you need in order to decide where to go out of the business. Because you will find no sign to tell you, well, this is the good time to sell the security. But what would happen here, the fundamental analysis, these figures and numbers and information might help you to understand and give you a clue that the business is sinking down. So you don't want your return to sink and you don't want to lose the opportunity to rescue your return. So again, the fundamental analysis is going to be very good in pinpointing the health, continuously the health of the business, and it enables to give you some messages of when to buy and when to sell. Again, the fundamental analysis is going to always enable you to understand the health of the company, and that's what you need actually in order to make your decisions. The other thing that we have to understand that there are some other informations that we get, like one of the informations that we usually have to listen to and then try to support our decision with when making investment decisions is to go for the messages from the CEO. So the CEOs usually would definitely make you enabled to think about the future of the company, and that's very good to think about the future of the company, and they might make the future looks bright, but actually in fundamental analysis we need here to go and base our analysis on reality. So what we need to know what the company is doing now in order to trust that management team to go and execute their plans in the future. So if they're good previously in execution, this would give us a good understanding that the company will even continue in order to do some successful management for your money, because when you invest, you are delegating this management in order to make decisions in behalf of you. So you need something tangible. In fundamental analysis, you need the tangible evidence. It's very similar to a student coming to me and say, oh, I've worked really hard. Working hard is excellent, but actually we need tangible evidence, like a report card would say how much hard you've been working during the previous period. So that's the execution and the current performance of the company would give us a good support for our decisions in fundamental analysis. The main target actually of fundamental analysis is to pick these worthwhile investments. When I say worthwhile investments, I mean these investments that worth what you're paying for. So when I say worth what we're paying for, that means we have to know how much this investment's worth, or how much this is stock actually. If I want to specifically talk about fundamental analysis in stock and in stock markets, that means I would say I need to know what is the actual price, the fair price, the intrinsic value of the company, in order to be able to make better informative judgment about the performance of the company and be able to take successful investment decisions. So always remember, when you are buying a stock, this means you are paying money for that piece of ownership. And you need to utilize all these skills, all these numbers, all these available information in order to make a good judgment about the future of the investments. So we talked about then why do we need fundamental analysis, and how the fundamental analysis would try to support our investment decisions. But when we say we're focusing on fundamentals of the company, what do we mean? Well, we don't only focus on quantitative data, not only numbers in order to take our decisions, but again, qualitative data. So we don't only take the quantitative, but the mixture of quantitative and qualitative data would be very important for us in order to do more informative decisions about the investments. I just had the 5 classifications of the investments, of the fundamentals, the information that we have to look for when we analyzing a company. And actually most of these are available, because most of the companies are all listed companies are so regulated and scrutinized well by authorities, by the stock exchange, make sure that they have enough disclosure, timely information disclosed in the market. So this makes the fundamental analyst's job a lot easier. So all the things you need to pay attention to are usually listed and published for all to see and look at. So generally when you hear about the company fundamentals, then you look at these different categories of the information. As I said, there might be financial performance indicators. What do I mean by financial performance? Here we are looking for how much the company collects from customers, who buys its products or services, and how much it keeps in profit. And in this case, we are talking about revenues, expenses, earnings, profits. We talk about cash flows. All of these are indicators, and we're going to talk about these different financial ratios that are going to support us in order to try to analyze the company's health and performance. Again, it's good to do well, to sell, but it's much better to keep going and growing. That's why we say we need here to look at how much the company has access to financial resources. So it's not enough for the company to sell goods and services. It's not even enough to only turn profits, do the return of the profit, but actually companies must also have financial firepower to invest in themselves and keep that business grow in the future. So the promises of the growth means adding more value for the shareholders. And the more the company has more access to financial resources, the more the company will be able to have more opportunity of growth in the future. So when we talk about the financial resource, we have to look at the liabilities and the assets and that leverage part that we might need to analyze and see how much this has been utilized during the previous period. Again, we have the fundamentals related to the financial or the management team. So the management team are going to be those who you trusted in order to give them money and then make your money at work. So this cash to work process is going to go through that management team. So that's why fundamental analysis needs to deal with the with analyzing good and separating good from bad managers. And when I say good, that means through what the results are. And again, it's very important to look at the supervision process that has been made on these management in order to achieve their targets. And that's where we analyze the corporate governance and how this been implemented during the previous, who's governing, who's supervising, who's actually making these strategies or planning into implementation. The other thing that we have to, other group of fundamentals that we look for is valuation. It's not enough to identify which company is going to be best, but what is good company is not really clear. So we don't know whether good, all companies are good, all listed companies are good, but actually the definition of good can run to be gamut. So what we have to do, you are also need to consider how much you are paying to own this stock. So that's where we look at the actual value of the or the price in the market, and how this is related to other factors in the companies, like the earnings multiples, or again, you need here, when you are talking about a potential investor, this potential investor needs not to pay too much for even the best of the world company. If the company is doing really great, and you pay too much for a great company, that means this is a definite loss that you're going to go for. So that's why we have here to stop to see what is the appropriate value or for the company, in order not to overspend or overpay for that company and then end up not to earn any return during the future. The other fundamentals that we are actually concerned with in fundamental analysis is what we call macro trends, because no company is working or operates in vacuum. Okay, we're not in a capsules, we are part of the whole economy. So a company's performance is highly affected and influenced by actions of competitors or the conditions of the economy. So that's why we have to look at the economic factors, economic indicators, and the health of the indicators that's going to show you how the economy would look like during the future. So we have indicators, gets forward-looking read on the economy, and these indicators might be many. I'm just going to give examples of, for example, money supply, GDP growth, interest rate spread, consumer expectations, unemployment rates, even building permits. All of these are going to be some good indicators that you look at in order to decide how the economy would look like during the coming period. Actually, fundamental analysis generally breaks the business cycle down into 5 primary phases for the economy. From expansion, because the economy it moves from time to another time, but we need to get some indicators to know where we are in order to understand how to pick the best investment during the coming period. So these phases might be expansion, peak, contraction, trough, recovery. So maybe this needs one standalone session, and maybe in other sessions we can talk about these in more details. But actually, in here we are talking about the economy that might be in a boom or in a bust. So we understand that this is going to be part of the fundamentals that we have to look at before going through judging the investments that we own now, or even we are potentially going to have during the coming period. So we follow different approaches in fundamental analysis, but all of them should go into the 3 steps. It's EIC or CIE. So it's bottom up approach, where you start from the company analysis, industry analysis, and then economy, or you start, which is the most recommended one, from the economic analysis, industrial analysis, and then company analysis. So I'm just going to give you an example of if we are going to look at the current situation that we live in currently of COVID-19, we can see that companies, the economy, all the analysts are expecting contraction in the economy. So what would be the decision here? Are we going to stop to invest in the financial markets? Definitely no. Okay, there will be, even in contraction periods, we can see that there are some industries prospering during the coming period, and there are some promising opportunities for these investments. We have different types of companies that, or industries, that might react differently to the whole economy. So we can see the economy that, for example, if I talk about cyclical businesses that goes with the cycle, with the different cycles of the economy, I'm talking about durable consumer products, or let's say automobile, homes, different examples of industries that are very sensitive, luxury products, companies. All of these are going to be actually react to the economy as goes with the economy. That we call them cyclical businesses. But even within these businesses, we can see that there are some firms that can utilize chances because of their strength. Let's say, I'm just going to give you an example of the Walt Disney in 2008. In 2008, Walt Disney started to innovate and invest in their parks and retheme their parks amid the 2008. So everybody been sacrificing from the recession 2008, but actually this company has utilized the opportunity because it was strong enough to pay for their for better investments that makes them even stronger after the crisis. Another example of Rolls-Royce that announced just recently about a huge, large reserves of cash that they are putting one side in order to invest it during the COVID-19, in order to be stronger, to innovate in their businesses. So this depends very much on the strength of the company. So the strong companies can even, and different economic conditions can act, but depending on the strength of the company itself. So what I wanted you to know, that not all companies would react similarly to the economic or industrial changes. So that's why we have here to think about the strength of the company, and we need here to have a good focus about the company analysis to see how the company will be able to act to these different changes in the economy. So we need to learn the language of the accounting language, and we need here to have a good interpretation to the information disclosed or the information published about the company. So most of the information, the publicly available information, are available in financial reports and disclosures of the company, and mainly in financial statements. We usually have 3 main financial statements: the balance sheet, income statement, cash flow statements, and we need to look at them here more analytically rather than just looking at numbers. We have to understand what's going on through looking at these financial statements. So let's start with the first financial statement. That's just going to give us a kind of snapshot. So we call it the snapshot of the firm's assets and liabilities. at a particular point of time. So what are the main items included in that balance sheet? This balance sheet would show us these two sides, the right-hand side and the left-hand side. The right-hand side would show you where you get the money from. And the left-hand side, which is the total assets, would show you where the company invested the money in. So if you own part of this company, then you would see that where your money is going to. Okay, so in the left-hand side, you can see the total assets, and these assets, as I said, you look at them as different types of investments, and these different types of investments usually categorized in balance sheet, usually depends on the industry, but usually from most liquid to least liquid assets. And if you look at the upper portion of the assets, we usually put the current assets, or the accountant would disclose the current assets, the most liquid assets usually operating like cash, account receivables, inventory, other short-term assets, marketable securities, short-term investments. So all of these are going to be included into the upper portion of the asset side of the balance sheet. The lower portion of the asset side of the balance sheet would show you more information about these longer term investments. So again, it depends very much on the type of the industry itself. But when we see the company is investing on the long term, that it depends on the, as I said, in the industry. So we can see banking institutions disclose their long-term investment in a different way than the proportion of each would be different depending on the industry itself. So the second portion, which is the lower portion of the total assets, would show you how much the company is investing, and we actually say we're expecting more return out of that portion of the assets. If we go here into these different investments, we have to think about these financing decisions that have been made by the management to finance these different types of short and long-term investments, tangible or intangible investments. And this would be listed into the right-hand side of your balance sheet, which is total liabilities and stockholders' equity. Again, liabilities and is going to be categorized from the shorter term to longer term obligations. That's how much you owe to the debt holders. So the current liabilities were due during the year, not more than 1 year. But longer term liabilities like bonds or even long-term debts, these are going to be due in more than 1 year. We're expecting that the cost for the short-term assets would be a lot less than the cost of long-term liabilities would be. The cost of long-term liabilities would be a lot less than the cost of longer-term liabilities. And again, the short stockholders' equity would show how much the par value of the stock, which is a regulated value in Qatar Stock Exchange, always 1 riyal for each stock, and paid in capital means anything that we sell the stock for more than the par value. Retained earnings, any reserves of non-divided profits would be part of the owner's equity. So that's only a sheet that's going to show investments and resources of investments. And again, if you look at the mid side, you would see in this side, you would see what we call net working capital. So we talked about liquidity, and we say companies have to look at the need to look at the liquidity, always be able to meet their obligations. That's why they usually do that kind of matching between the short-term assets and short-term obligations. And in most cases, companies need to have excess short-term assets than short-term. It depends again on the industry itself. And the difference between the short-term assets and short-term liabilities is what we call net working capital. And this indicates how much more liquid assets the company has relative to the short-term obligations. Again, we need here to be ready to meet obligations. Obligations meet commitments. Not being able to meet these obligations might lead the company into the risk of default. So that's why we have here to see how the management been taking decisions in order to do that kind of balancing between the more return they can generate from longer term investment, which is long-term assets, and the ability to meet short-term obligations. So that balance would actually would actually be in what we call net working capital. So the larger the net working capital, the more the liquidity, but we don't want this liquidity to be high to affect the return on equity or return that we can generate from the investors. So that's actually what the balance sheet look like. So if we look at the balance sheets as building blocks, then we have here to look at these different blocks of the balance sheets to show you how you invest, how you get the money to invest in the company, and how this is translated, or the decisions that have been taken by the management been translated into items would appear in your balance sheet. Now, the income statements is very important to look at, because this income statement, we call it the video recording. It just records how you've been performing during the year, and the main thing, it just shows the revenues and expenses, how much sales fees you get from your services, and we start here to deduct these different types of expenses, starting from the cost of goods sold, or the direct cost of your sales and services, and you start to think about different types of profits. Every time we are deducting different kinds of expenses. So when we look at the operating income, then we say this is going to be the revenues that we generated minus the variable cost, and again the operating expenses that the company has to pay and to meet, like selling expenses, administrative, and some of them might be cash and some others might be non-cash. So in accounting, accountants are allowed to depreciate the cost of the asset that they pay, fixed asset, long-term assets, over time. That's why they recognize part of the expenses, what we call depreciation and amortization expenses, and these are non-cash expense, but they are recognized in the income statements in order to show to see how much exactly the taxes need to be paid. So the bottom line, every time we reach the bottom line of the income statements, we are going to go and show how much the income that can be distributed between shareholders, and how this is would be actually reflecting the book and performance of the company. So all of this is going to be only book values. As I said, this is prepared by the accountant, and this is what we can share. After meeting all these commitments, the shareholders will expect that the company will be able to pay dividends. Again, dividends is implicit commitment. It's not explicit. We don't have to pay it like interest, but actually we implicitly prefer that the company would be compensating the shareholders, but sometimes they might decide not to, but they would promise to create more value in the future, and that's why they will reserve these profits to grow and prosper for the coming years. The two statements prepared, or the income in particular, the income statement prepared by the accountant actually follows what we call the accrual base. So we just record the sales and everything and the expenses, whether they happened to be translated in cash, or we did not pay them. So that's what we mean by accrual base. So accrual base, when we look at the sales, we just include the sales, the sales whether we made it or we did not made it. We did not collect it. Yeah, we made it, but we did not collect it yet. So it's so important to look at the third statement, which is the cash flow statement. This statement is very important for analysts because it just shows how the cash flows, okay, will go in and out of the company. So we need here to bring explanations why the cash has been changing from the beginning of the year till the end of the year. So we had to show this in another statement. The accountant showed this in another statement called the cash flow statement. So the accountant would need to categorize these cash flows into three categories: cash flows from operating activities, investing activities, and financing activities, to make it easier to do that kind of classifications of why these changes has happened to the cash during the year. Remember that the company should not dry out of cash. Even successful companies need to make sure that we have that blood into the company in order to continue and sustain for a longer time period. So the cash flow from operating activities, this section is more responsible about the cash coming in and out from customers, okay, suppliers, materials, payments of taxes, and this is mainly from just to deal with the changes in the items that represents operating activities. Cash flow from investing, it's more responsible about the investing activities, about how much the company paid to buy more assets and how much the company has collected from selling some of the assets, or how much the company maybe invested in another company. So this would show you how much exactly the company paid for these investing activities. For the cash flow from financing activities, it's more about financing. And when we talk about financing, you remember that it's borrowing. And again, it's the it's from the two sources, borrowing or even more stockholders' equity. So the changes in stockholders' equity, changes in liabilities, short-term or long-term, is going to be in this part. Any dividends being paid, again, would be in the part of the cash flow statement, in the lower part of it, which is the financing, cash flow from financing activities. These are the accountant information. These are the three statements prepared by the accountant. But actually, we have to go further step here to look at what we call the free cash flow. So the free cash flow concept is going to be important in fundamental analysis, where we have to see how much the company has generated from its assets. And this cash flow generated from these different types of assets should be sufficient and enough for the creditors, and for these are the two suppliers of the company, the creditors and the stockholders. So we generate the cash. If you go back to the balance sheet, we say assets is equal to the liabilities, then equity. It's the same case here. What you generate from cash from your assets should be sufficient for paying for your creditors and, again, the stockholders, owners of the company. So the free cash flow from assets is the operating cash flow, anything that you generated from your operation during the year, minus any investments on the long term, and that's what we call net capital spending. We expect the company to grow, so we expect would be reduced by the net capital spending, minus any changes in net working capital, and in this case we are talking about short-term investments as well. As we said, this free cash flow concept is going to be very important to see what we're expecting. So we expect the company to pay for creditors, and what creditors actually would share with the company is only the interest that they have to receive. And again, any changes involve paying back of the principal amount. That's another thing. Or maybe might be positive or negative if the company has borrowed more. So it depends on the company and the activity of the company during the previous year. The last thing is the cash flow to stockholders again, and this cash flow to stockholders again, we're expecting dividends, we're expecting any changes in equity raised. So we need here to make more standardization to answer more precise questions about these accounting information, and that's what we do through what we call financial ratios analysis. So financial ratios provide you with a method for doing a kind of calculations for relative values, to do a kind of standardization of information. We extract the items from balance sheet and income statements in order, or maybe some market information, in order to make some more conclusions about the company's performance. Again, you need to always remember that financial ratios meaningless. So the number itself, it means nothing, but what we need to do is to do a comparison between these different ratios. So we say ratios might be higher, lower, better than the comparison. So we do what we call time series analysis. We compare with previous year the performance of the company, or we do cross-sectional analysis where we compare X company with Z company from the or the competitors. And again, we might do the combination of time series and the cross-sectional analysis in order to get some conclusions about the performance of the company. Well, we have different categories of financial ratios. Each category try to answer a particular question. So how liquid is the firm? It will be able to pay bills as they become due? That will be an answer we get from what we call liquidity ratios. How can the finance the purchase of the assets? Again, that's what we call the capital structure ratios or leverage ratios. How efficient has the firm in managing or utilizing the assets and being able to generate sales of the assets? That's what we call asset management turnover or efficiency ratios. Has the firm earned adequate return on the investment? That's a very important question we ask as investors in the company, and this would be answered through what we call profitability ratios. Are the firm managers creating value for shareholders? Again, this is going to be answered by what we call market value ratios. So market value ratios is kind of bridging between the market and the book values in order to give a good conclusion about the market performance of the company. So these are the ratios. I'm not going to go into details. I know that we don't have too long to go, but actually, just briefly, these are different. As we said, we might have longer list of ratios, but actually each group is going to give you a particular indication about one aspect of the company's performance. So when we say liquidity, it's ability of paying the obligations on time, and mainly short-term obligations. So we focus on the current assets and its relation with current liabilities to calculate current ratio. Quick ratio, these most liquid assets relative to the current liabilities. Cash ratios, how much cash you have. This might be very interesting ratio for a very short-term creditors would need to see how much the company is able to pay a very shortly due obligation. As I said, we have that leverage ratio, which is another group of ratios to do a kind of comparison between the different types of financing. So the more the debt you have into your capital structure, the more the risk. that the risk comes from the obligations, that extra obligations and commitments you need to meet, which is the interest obligations. And if you don't meet these obligations, that would increase the probability of default for the company. That's why we say it's more risky to go for debt as a source of financing versus the equity, because there is no commitments in paying dividends in equity when we finance by equity. But again, issuing too much debt, this is going to be very risky for the company, because you will never guarantee that you are going to have a successful story end of each year. Again, even these companies, these leverage ratios, even if they are going to be high, this is might be justified if the company is able to serve these loans, and that's how we judge it, through what we call times interest earned or cash coverage ratios. These ratios are going to show how much the company is generating sufficient level of operating profits in order to meet the commitments of the leverage, which is mainly interest and fixed charges. So that's actually the group of ratios that we analyze the risk of the company, or the particularly the credit risk of the company, through looking at the portion of leverage ratio, capital structure ratio. Asset utilizations, these different turnovers, this should show you how much you are selling, how much you are going to grow to collect from your account receivables, how efficient you are in paying on time, and how much you've been turning these assets into revenues. And the more you have this turnover, higher turnovers means the company or management are more efficient in managing these different assets, and we expect that the company would have higher profitability. This would be checked through what we call profitability ratios. So in profitability ratios, we just need to see how much profit, net income, and these bottom line items like net income relative to sales, and that's what we call net profit margin, return on the total assets, net income to total assets, return on equity, and etc., etc. The other group of ratios is market ratios. That's very interesting ratio, because these multiples are going to show you how much you perform relative to your competitors as well. So this is what show you the market reaction to your performance. So the market to book ratio, price P over E ratio, it's the price per share divided by earnings per share. So we try to take some indicators from the market, some indicators from the books, and then we compare between them price to earnings, P over E, just show you how much they pay, how much the market participants are ready to pay per $1 of earnings has been recorded in our books, or expected to be achieved in the company. Again, we have the price to sales. Again, that's the price per $1 of sale. Market to book ratio, that's the market price relative to the book price. And when we say book price, it's the accounting book, which is the total equity divided by number of stocks outstanding. We have the EBITDA ratio. That's more comprehensive ratio to show not only the equity value, but the equity and debt value relative to the operating profit before deducting all these different expenses like depreciation, amortization, taxes. So all of these are going to be indicators just to see how the market is reacting to the performance of the company. The last part that I'm going to go quickly to is the valuation models. Valuation models, as I said, needs maybe a 1 week or more course in order to make you able to go through and understand all the details of valuation. How can we judge the actual value or intrinsic value of the company? But I'm just going to show you these most famous models that we use. Again, it's not about the calculations, it's about the estimations of the inputs for the models. So the more accurate you are into forecasting these values, the more would be the accurate judgment for the value of the actual or the fair value of the company. So we have the dividends as indicator. So in valuation, the concepts that we're using in the dividend discount model and the discounted free cash flow model, that we discounted what we expected to get in the future into now value. So we need to know how much now we pay for what we're expecting to receive out of the company. That's a concept actually of that valuation. You pay for something in order to utilize the benefit in the future. So in these valuation models depends on the discounting. And what do I mean by discounting? It's a simple time value of money calculations that you learn in order to see how much series of cash flows worth today. Okay. So the dividend discount model just show you that if you invest in a company and this company is paying dividends, then what we have to do to estimate the stock, depends very much on the series, the upcoming infinite number of perpetual number of series of dividends that you are going to receive as an owner. And if we presume that these cash flows are going to grow in a constant growth rate, that means every year the company is paying you more dividends every year to compensate you more for the expected inflation or some extra growth rate, supernormal sometimes growth rate, then we use this formula. We just say this is the last dividends paid, and we multiply it by 1 plus growth rate over the R minus G, or it should be K minus G. So what is the discount rate that we're using? This R or K we usually use actually is what we call a discount rate. This discount rate depends on the cost of capital. So this is the cost you're paying for the money that you're using on all these different investments that will enable the company to generate dividends and pay you dividends over time. So that's going to be very similar, estimated through different models. It's not easy to be estimated, but actually it's estimated just showing you how the required rate of return on an investment would look like, and this would be a factor that you use in order to do the discounting. So if I have a company pays regular dividends per share is equal to 2 Qatari Riyal, cost of capital or required rate of return 10%, sustainable growth rate 2%. So what is the maximum you pay for this company? You just say it's 2 times 1 plus 2%, which is a growth rate over the difference between the cost of capital or the it should be required rate of return minus the growth rate. So this is going to be the maximum that you pay for this company, estimating that these are actual number or accurate number, then this is going to be 25.5 Riyal. So that's simply how we use the dividend discount model. Discounted cash flow model depends on discounting the free cash flow that we have just mentioned before. Different estimations of free cash flow might be used, but actually we use the same concept by dividing just discounting the free cash flow. This is useful for the companies that don't pay dividends. As we said, some companies might be not dividend paying companies, so this might be a escape where you use what we call the dividend, the discounted free cash flow models. So if we go to another model, which is the relative valuation model, I see that I'm going too much with this, but the relative valuation model, we use the market in order to indicate what would be the value, the appropriate value for the company. So in relative valuation, the value of the stock is compared with the similar comparable competitors, peer groups that we might create, and then these peers are going to be identified very carefully in order to see how their multiples would look like. So we calculate the average of these multiples in order to do a comparison, compare the multiples for the stock. You are analyzing to the average values of the comparable stock, controlling for the difference, any differences between the firm that might affect these multiples, and then you judge what would be the value of the company. The value might be overvalued or undervalued. It depends on the price that, or the value that you have calculated. So if I have a company has an industrial average of P over E equal to 5 and projected EPS for the company is equal to 4, then if we multiply the two of them, we get the 20. So the 20 is going to be the price based on the selection of the industrial average for that particular company. If I have to do a judgment, then I say, if I see the price in the market 15 and I'm getting 20 as a price for the company, then what I say this company is undervalued. So if the market price is 15 and what I'm getting is 20, that means this is undervalued. So this is attractive investment to be bought, expecting that this price will catch up and improve over time. So the mispricing is not easy to be actually achieved. It's not obviously easy to be achieved. The more the efficient the market is, and the more more financial fundamental analysts are available in the market. So we expect that if the market is efficient, that the prices in the market would be fair, and it's not easy to get these opportunities of undervalued securities. But if you hold the security and you find this stock is overpriced, that means this is maybe a good time to sell the security, because we would understand that the prices will drop again during the coming period.